Hi, today we would be discussing international financial system under international business. So, international financial system. It's from the time Bretton Woods became effective, it was inevitable it would break down. It tried to achieve incompatible objectives, freedom of countries to pursue an independent internal monetary policy, fixed exchange rates, and relatively free international movement of goods and capital. That is what Milton Friedman said. The gold standard, which was there from 1880s to 1913. So the gold has historically been used as money mostly for its ability to be a good store of value. Gold did not tarnish or erode easily and was fairly scarce. It was also a useful medium of exchange since it was desired by most people and could be transported in fairly small quantities. Gradually, the use of gold for money turned into the minting of coins whose face value typically was equivalent to the intrinsic value of gold. Beginning in the late 19th century, the world moved away from gold coins to paper money with the requirement that the paper was convertible into gold. A holder of a banknote could, if he or she so desired, exchange it for the equivalent weight in the gold. By 1880, most of the major trading nations had adopted this monetary system. The interim years, the story was that onset of World War saw the end of the gold standard as countries other than United States stopped making their currencies convertible and started printing money to pay for war related expenses. After the wars, the focus shifted from external cooperation to internal reconstruction, and events like the Great Depression further illustrated the breakdown of the international monetary system, bringing such bad policy moves such as a deep monetary contraction in the face of a recession. The Bretton Woods, which was there from 1945 to 1971, Bretton Woods actually is a little town in New Hampshire, famous mostly for goods skiing. In July 1944, the International Monetary and Financial Conference, organized by the United Nations, attempted to put together an international financial system that eliminated the chaos of the interwar years. The terms of agreement were negotiated by 44 nations led by the United States and Britain. The British delegation was led by John Maynard Keynes, perhaps the most famous economist of 20th century. The main hope of creating a new financial system was to stabilize exchange rates, provide capital for reconstruction from the war, and encourage international cooperation. What they settled on constituted the primary features of the Bretton Woods Agreement. And what were those features? The features of the Bretton Woods system can be described as a gold exchange standard rather than a gold standard. The key difference was that the dollar was the only currency that was backed by and convertible into gold. The rate initially was $35 an ounce of gold. Other countries would have an adjustable peg vis-a-vis the dollar. Basically, they were exchangeable at a fixed rate against the dollar, although the rate could be readjusted at the certain times under certain conditions. The dollar or the pound, the British pressure added this clause that pound should also be exchangeable, could be used as a reserve currencies for intervention in foreign exchange markets. Each country was allowed to have 1% band around which their country's currency was allowed to fluctuate around the fixed rate. The International Monetary Fund, we have read it before, and in our international financial system, we are repeating here again. It adds up to our story of international financial system, which says that the International Monetary Fund was created with the specific goal of being the multilateral body that monitored the implementation of the Bretton Woods Agreement. Its role was to hold gold reserves and currency reserves that were contributed by the member countries and then lend this money out to other nations that had difficulty meeting their obligations under the agreement. But the increasing supply of dollars worldwide meant that the credibility of the gold backing of dollar was in question. US dollars held abroad grew rapidly, and this represented a claim on United States gold stocks and cast some doubt on the United States ability to convert dollars into gold upon request. In 1971, the US government closed the gold window. By 1973, the world had moved to search for a new financial system, one that no longer relied on a worldwide system of pegged exchange rates, that is, Bretton Woods Agreement, collapsed. Surprisingly, the collapse of Bretton Woods system did not lead to a widespread rush to adopt flexible exchange rates. Instead, the post-Bretton Woods era has mostly been about a search for individual or small group adaptations of fixed exchange rate or managed floating exchange rate arrangements. What about the post-Bretton Woods era? In order to ensure New World economic order and peace, it was necessary to restore stability in monetary system at international level and find effective means to reconstruct the war-ravaged economies of European countries. But stable peace could be achieved only by diverting a part of world resources to the underdeveloped and undeveloped poor countries of Asia, Africa, and Latin America. An effective solution to the problem of economic reconstruction and development was necessary for ensuring world economy and for dismantling the complex trade and exchange restrictions that had grown during the previous decade. In order to abolish all trade and exchange restrictions effectively and to promote the multilateral trade system, IMF was established on December 27, 1945. It started functioning from March 1st to 1947. The main objective of IMF is to grant loans in foreign currencies to member countries to correct any disequilibrium in their balance of payments when disequilibrium is of temporary nature and likely to be removed in the earliest possible period. According to the article first of the agreement, the objectives of IMF are to promote international monetary cooperation through a permanent institution of the fund, which provides the machinery for consultation and collaboration on international monetary problems, to facilitate the expansion and balanced growth of international trade, and to contribute thereby to the promotion and maintenance of high level of employment and real income, to promote exchange stability and maintain orderly exchange arrangements among members by avoiding competitive exchange depreciation, to assist in the establishment of a multilateral system of payments in respect of current transactions between members and elimination of foreign exchange restrictions which hamper the growth of the world trade. Also, to create confidence among members by making the general resources of the fund temporarily available to them and providing opportunity to correct maladjustments in their balance of payments without resorting to the major destructive of national or international prosperity. International liquidity. International liquidity is generally used as a synonym for international reserves. Such reserves include a country's official gold stock, holdings of its convertible foreign currencies, SDRs, and its net position in the International Monetary Fund. It is the aggregate stock of internationally acceptable assets held by the central bank to settle a deficit in the balance of payments of a country. In other words, international liquidity provides a measure of a country's ability to finance its deficit in the balance of payments without resorting to adjustment measures. IMF in 1970 introduced a scheme for the creation and issue of special drawing rights as unconditional reserve asset to remove all the related problems of international liquidity. Now, SDR is the principal source of international liquidity to its members. On July 1974, the value of 1 unit of SDR was fixed on the basis of basket of currencies of 16 countries. In 1978, the currencies of Denmark and South Africa were excluded from the basket of currencies, and the currencies of Iran and Saudi Arabia were included. In 1981, the value of SDR was again fixed in 5 currencies, in which American dollar, British pound, mark of Germany, franc of France, and Japanese yen were included. At present, the value of currency of every country is fixed in SDR. Mutual exchange rates of different currencies can be increased or decreased according to the demand and supply in the market, and thus the par value system started by IMF has been ended by the floating rate system. The European Economic Community, an arrangement used briefly in Europe after the collapse of Bretton-Woods system, in which European currencies were permitted to vary plus minus 1% against each other, thus the snake, but plus minus 2.25% against the dollar, that's known as the tunnel. An adjustable peg system was born among the countries belonging to the European Economic Community. This was a snake created in 1972, designed to keep the economic community, the European Economic Community countries' exchange rates with narrower bands of 1.125%, while they maintain the wider bands of 2.25% against the currencies of other countries. Hence, the designation snake in the tunnel is used. In 1979, the snake became the European monetary system, with all EEC countries except Britain joining the club. It proposed a combination of adjustable peg with wider bands. The feature that distinguished EMS from the snake was the European currency unit, a SDR-like basket of currencies which was to play the role of the unit of account for transactions among the member central banks. The ECU, that was European Currency Unit, was the precursor of the common currency euro, which the 12 member countries of EMU now share. The EMS has operating mechanisms which guided member countries' intervention in the foreign exchange markets to maintain the bilateral rates within the permissible bands and financial agreements, which provided reserves to member countries whose currencies came under pressure from time to time. Monetary union has been emphasized as a part of the move towards creating a single economic zone in Europe with complete freedom of resource mobility within the zone, a single currency and a single central bank. Finally, the single currency euro came into existence on January 1, 1999. The parities of the 11 member currencies against the euro were irrevocably fixed on December 31, 1998. Subsequently, on January 1, 2001, Greece joined the Euro group. About the European Investment Bank, it was established in 1958. It is the European Union's long-term lending institution. As a policy-driven bank, the European Investment Bank supports European Union priority objectives, notably European integration and social cohesion, through its financing operations. As the Bank of European Union, the European Investment Bank's mission is to make a difference to the future of Europe and its partners by supporting sound investments which further European Union policy goals. The European Investment Bank is owned by the 27 European Union countries. It borrows money on the capital markets and lends it at a low interest rate to projects that improve infrastructure, energy supply, or environmental standards both inside the European Union and in neighboring or developing countries. In 2008, the European Investment Bank raised nearly 60 billion euros. The European Investment Bank works on a non-profit basis. What are the services given by European Investment Bank? It extends loans, and loans are granted to viable capital spending programs or projects in both the public and private sectors. Recipients range from large corporations to municipalities and small businesses. Technical assistance is provided by the team of expert economists, engineers, and specialists to complement European Investment Bank financing facilities. The guarantees, which are available to a wide range of bodies, for example, banks, leasing companies, guarantee institutions, mutual guarantee funds, special purpose vehicles, and others. The venture capitals, requests for venture capital should be addressed directly to an intermediary. These are all the services provided by the European investment banks to its member countries as well as the developing countries. What is the lending within the European Union? About 90% of loans go to programs and projects within the European Union. The European Investment Bank has six priority objectives for lending set out in the bank's business plan. What are they? They are cohesion and convergence, support for small or medium sized enterprises, environmental sustainability, implementation of the Innovation 2010 initiative, development of trans-European transport and energy networks, that is TENS, and sustainable, competitive and secure energy. About the World Bank, it was originally established to support reconstruction in Europe after World War II, but has since reframed its mission and expanded its operations both geographically and substantively. Today, the bank's mission is to reduce poverty. It has over 184 member countries and provides over $24 billion annually for activities ranging from agriculture to trade policy, from health and education to energy and mining. The World Bank provides funding for small and big projects as well as to promote economic and policy prescriptions it believes will promote economic growth. For example, part of the over $300 million the bank is currently providing the West African country of Niger fund health programs addressing HIV or AIDS and irrigation. However, the bank also promotes more controversial projects in the country like privatization of state enterprises. The World Bank is not a bank in the common sense of the word. A single person cannot open an account or ask for a loan. Rather, the bank provides loans, grants, and technical assistance to countries and the private sector to reduce poverty in developing and transition countries. The World Bank Group is actually comprised of five separate arms. Two of those arms, the International Bank for Reconstruction and Development, that is IBRD, and the International Development Association, work primarily with the government and together are commonly known as the World Bank. The two other branches, the International Financial Corporation and Multilateral Investment Guarantee Agency, directly support private businesses investing in developing countries. The fifth arm is the International Center for Settlement of Investment Disputes, which arbitrates disagreements between foreign investors and governments. World Bank's major contribution in India has been very wide, that it has been giving certain subsidies for elevation of poverty and creating infrastructure. Now we come to the topic that what is the difference between international monetary system and international financial system? About the international monetary system, it constitutes an integrated set of money flows and related governance institutions that establish the quantities of money, the means for supporting currency requirements, and the basis for exchange among currencies in order to meet payment obligations within and across countries. Central banks, international Financial institutions, commercial banks, and various types of money market funds, along with open markets for currency and, depending on institutional structure, government bonds, are all part of international monetary system. The key distinguishing factor for the IMS is that money, in contrast to financial assets, is not interest bearing. Money is used as a unit of account and or medium of exchange to support and foster the exchange of goods and services and capital flows within and across countries, to calibrate values and advance the exchange of financial assets, and to foster the development of financial markets. Traditional definitions of money also include its role as a store of value, but that role has been largely assumed by financial assets. Although this view may be controversial, the store of value for money is at a minimum shared with the international financial system and may be completely assumed by it. The international financial system. It constitutes the full range of interest and return bearing assets, bank and non bank financial institutions, financial markets that trade and determine the prices of these assets, and the non market activities. For example, private equity transactions, private equity or hedge fund joint ventures, leverage buyouts, whether bank finance or not, that is irrespective of that. And this is through which the exchange of financial assets can take place. The international financial system lies at the heart of the global credit creation and allocation process. To be sure, the international financial system depends on the effective functioning and prudent management of the IMS and the ready availability of currencies to support the payment system. Nevertheless, the international financial system extends far beyond international monetary systems, common payments, and currency pricing role to encompass the full range of financial assets, including derivatives, credit classes, and the institutions that engage in the exchange of these assets, as well as their regulatory and governing bodies. The international financial system encompasses the international monetary system but extends in function and complexity well beyond international monetary system. Government debt links the two systems, as government debt can function as a near money in a zero interest rate environment. Many financial transactions pass through a stage of payment in money, that is, in terms of demand deposits, or quickly to a riskless interest bearing asset like government bonds. When riskless assets become more risky and less liquid, the payment system slows down and may even be upended. For example, the sovereign debt crisis, such as the one now underway in Europe, is primarily a crisis of international monetary system. Sovereign debt lies at the heart of a monetary system because it constitutes a source of riskless assets that balance the risk profile of other assets held on bank balance sheets. When interbank markets become concerned about the quality of sovereign debt, the event creates counterparty risk that disrupts interbank borrowing, which is a critical instrument of shared bank liquidity. As is the case in the current European crisis, the liquidity crisis within the banking system can have liquid currency implications because the mix of currencies on bank balance sheets may not match the mix of currencies required to meet payment obligations. What have been the policy implications of international monetary system and international financial system? So the distinctions between the international monetary system and international financial system are important for policymakers. Why? Because these events demand different policy responses. International monetary system events are often about the availability of liquidity, especially US dollar based liquidity, in the financial system to meet current payment obligations. International monetary system events can be resolved primarily through central bank action and common agreement. A critical factor here is the inherent limit in the international environment of a nationally determined currency. The problem is often not that there is too much of a given currency, but that there is too little and it is concentrated in the wrong places. International financial system crises are more complex and far reaching. They can involve regulatory and reporting changes. They have significant and enduring economic effects. In the extreme, central banks can be asked to play a role as lender of the last resort. In carrying out this role, central banks purchase non performing market assets to reduce the overall supply of toxic securities in the marketplace and rebalance the demand and supply of credit worthy financial market assets. Remedial actions and regulation tend to concentrate in financial institutions and markets rather than at the core of the monetary system, although the monetary system can be damaged by the severity of these events. So this was all about the international financial system and how is it different from an international monetary system. These are the references. Thank you for listening.